Shares of Equifax are under pressure today despite reporting better than expected guidance for the year ahead. Here to break it down is Ryan Griffin, an analyst at BMO Capital Markets. Ryan, thanks very much for joining us.
Hey, good afternoon. Thank you for having me today.
Can you explain the juxtaposition on what happened?
Certainly. So I think there's a few factors going on. Obviously, Equifax delivered an impressive quarter, beating results for the third quarter and then raising their guidance as well due to their USIS business with some mortgage outperformance as we saw interest rates come down following the Jackson Hole summit in late August. I think the investor community is mainly focused on the mortgage strategy and how that will impact their mortgage business next year, given the October pricing announcement from FICO, where FICO was seeking to disintermediate some of the credit bureaus in moving them out of the equation and work directly with some of these resellers instead.
And what are they keeping an eye on with the mortgage plan? What's the concerns there?
So the concern is just to the extent that Equifax will be able to mark up the credit file report that they have historically marked up in the past. And I think there's still a lot of questions in terms of what that revenue stream, which is about 20% of the P&L, will look like next year, not just for Equifax, but for the other publicly traded credit bureaus as well, in light of FICO's action.
And with that 20%, what about the other 80? How are those revenue streams looking relative to it?
Yeah, so we got some good news from the government segment where Equifax verifies using their workforce solutions database that various entitlement programs such as SNAP or Medicaid are able to use the Equifax data to ensure that they are sending payments out to the proper individuals that are entitled to receive those payments. In the One Big Beautiful Bill Act, there were some pronouncements that states will need to correct their improper payment rates or face some penalties in terms of the amount of funding that they get in some of these programs. So I think some of the states are going to move quickly to make sure that they don't lose any of these entitlement benefits, and that benefits Equifax as it entails greater usage of the workforce solutions database.
And I just want to talk a little bit about the U.S. mortgage revenue was up for the quarter, but the underlying mortgage market's declining. How was that playing out?
Sure. So that's a great question. It's because Equifax will take the FICO pricing, which was north of 40% this year, and layer that on top of the underlying mortgage trend. So in the quarter, they reported that mortgage inquiries were down year over year. Nonetheless, they were able to report somewhere in the neighborhood of high 20% mortgage growth because of that underlying FICO pricing. And that ties back to my prior comment about what the new mortgage market pricing scheme will entail for Equifax in light of the new pricing scheme from FICO.
Okay, and Equifax is bringing in the VantageScore 4.0 to rival FICO. What will we see with that?
Yeah, so a lot of questions there as well, given that Equifax, TransUnion, and Experian have owned this as a joint venture, and they have been trying to push this as a viable competitor to FICO for a number of years. However, I think they're going to put the pressure on a little bit more than they have been doing in the past, just given FICO's move and some of the defensive action that they've taken, and resulting in choosing for the lenders to potentially switch from FICO to VantageScore, given the price discrepancy now. Equifax has priced their VantageScore polls at around $450 per share, and the other credit bureaus are similar pricing, whereas some of the FICO pricing is in excess of that. And I think that is one argument that they are going to lean on to entice lenders to switch over.
And what would you be looking for to see that they're making an impact on FICO? They're actually making some inroads against it with that.
Yeah, so I think the lending community is starting to wrap their heads around what the nuances are between the two different scores. The Mortgage Bankers Association conference is ongoing now, so I think we'll get some scuttlebutt coming out of that. And in terms of how the different lenders and counterparties are thinking about switching scores or maybe maintaining the scores that they're using in the FICO score. Recall that FICO is held in the mid to high 90% market share in most lending asset classes. And the big question will be whether we see any shakeup as these news arrangements evolve in the next year or two.
And what else should we be looking for when it comes to Equifax?
So, as I mentioned before, there are a lot of borrowers that are tied up in the housing market right now, where maybe they purchased a home in 2021 or 2022 when interest rates were very low, and they've been looking to refinance or have simply been looking to move elsewhere. As we see rates continue to come down, this could enable some of those borrowers that are trapped on the sidelines to come back and engage in the mortgage market once again. And as that happens, it would be to the benefit of Equifax, as the various lenders will pull credit and income and verification from the Equifax databases.
Okay, Ryan, thank you very much for joining us today. We appreciate it.
Thank you very much.
Ryan Griffin is an analyst at BMO Capital Markets.